it's not one huge issue that's causing a problem for a bank. It's a set of things. There are small things that banks are overlooking that are happening at a certain scale. That's resulting in a problem.
I'm Dipesh Patel, editor at Trade Treasury Payments. Today we're in New Jersey and I'm delighted to be joined by the CEO and co-founder of Cleareye, Mariya George. Mariya, welcome. Welcome to your own city.
Thank you, Dipesh. Welcome to Jersey City.
Thank you very much. So today we're talking about trade-based money laundering. Why is it such a persistent challenge for banks?
It's a persistent challenge because historically, banks have treated that as an operational problem, not as a lack of intelligence domain problem. So what I mean by that is TBML does not, trade finance does not happen in silos. There are counterparties, there are, multiple documents, multiple jurisdictions. So if you treat trade-based money laundering in a silo, the problem is not going to go away. And also because the way the banks are operating, how the institutions are looking at it, you have different teams within the banks that are still operating in silos. So compliance team, AML team, operations team, they're not using one system. Many of the global banks have changed that approach, but still a majority of the banks are still working in silos. Those teams don't talk to each other. And unfortunately, the bad actors know that, and they are trying to take advantage of those silos and the multi-jurisdictions the banks work in.
Thank you. And actually, Cleareye launched a report very recently on the state of trade-based money laundering. What stood out the most with respect to the evolving risks that banks are persistently seeing?
There were two aspects in the report that was very surprising when we were doing the research and what came out of it, right? One is the pace at which TBML is happening is slow. Okay, what I mean by that is it's not one huge issue that's causing a problem for a bank. It's a set of things. There are small things that banks are overlooking that are happening at a certain scale. That's resulting in a problem. In other words, it's not a big number. It's not a big transaction that causes all kinds of red flags. So the chances of missing a potential red flag is so high because it's smaller value and it's happening at scale consistently. Make sense?
Yeah, makes sense. Trade routes are changing, trade finance is changing, and actually that's as a result of new bilateral deals that are forming. For example, the recently announced EU-India free trade agreement. How would you say new routes like this will create or present new risks to the market?
That's a really good question, and I say that because when new jurisdictions come in, tying it back to the earlier point, silos happen more because regulations are changing. People are trying to figure out the EU-India deal, the mother of all deals, is supposed to be, it will be great and will change the way trade is done. Now, for us to get to that and be prepared, for institutions to be ready for something like that to happen, you have to look at the regulations that are in the different countries. Institutions are not yet ready to figure out how to apply their current regulations to something like this. So adapting to the changes, not applying what is already there is going to be very important to make sure that bad actors don't take advantage of the situation. So that's one thing that we are seeing. And I say that because even when we work with global banks, what works in the US or in the UK is very different from what needs to be done from a regulatory point of view, even for the global bank in some of the APAC countries. So one solution, even though it's one solution, it needs to be customized or configured to fit the regulatory needs. India has separate regulations, so it is different. So the EU-India deal will be very interesting from that point of view to figure out, and would like to see what the institutions are going to do to adapt to that.
Another problem is data and unstructured data. Why is this causing such a compliance blind spot for banks?
Again, maybe silos is a theme of our conversation today. It's happening because, think about, like I talk about from a Cleareye point of view. When we deploy a product to a bank, we definitely have two teams that we are working with, operations and compliance. And our focus is on getting this unstructured data converted into a structured format so we can bring in efficiencies, minimize trade-based money laundering. That is how we go in. Even after that, the adoption from a compliance team or an ops team is different. The people who are working on it is different. And I say that because they're not talking to each other and they're not trying to solve the same problem. TBML, compliance risk, wants to solve a AML problem.
Yeah.
Ops wants efficiencies.
Yeah.
Very different end in mind for both parties. But now, when we have the technology today, right, we're talking a lot about large language models, for
Yeah.
example. It is amazing, it's beautiful that we have these technology breakthroughs because we're not just understanding, we're not just converting data into a structured format, we have the ability to understand what's in the data. So what do I mean by that? For example, you look at an LC. You have the 45, 46 sections in an LC which has the terms and conditions. This is human type text. Earlier, even with AI, with machine learning, there was limitations to what you can, to really understand what is written there. Now with LLM, with intelligence coming in, we can understand the intent of the sentence written in the LC. And then we can also assess the risk better. So, and then we can make recommendations better. So with LLMs in the picture, the products are becoming more intelligent. And if compliance and ops are adopting it,
Yeah.
then so much more better synergies between the two teams. And TBML can be reduced significantly.
Thank you. And I want to hone in specifically on a type of technology that keeps on being brought up, especially at this conference here in Jersey City, artificial intelligence. Hindrance, helpful, or an evolutionary arms race?
Definitely helpful. And let me tell you why I say that. And when you talk about AI, artificial intelligence, in the context of trade finance, think of it like there are three buckets. Okay, you always talk about intelligent processing automation. That's status quo. That's what everybody has been doing. We did it like 3 years back. It's just bringing in automation to processes. It's required for doc checking, doc examination, because we still do need to automate that. What's new as of last year was large language models. And I talked about, that's the second component of AI. We talked about it has the ability to think. Think of it like your brain. You're making decisions, you're telling why am I doing this. That's your brain. And the third part, which is very exciting in the AI race, is agentic AI. So that helps us decide how to do certain things. So what I like to say is you have your brain, your hands, and you have certain controls in place to your mind that tells you what to do. LLM is your brain. Okay, it helps you think, makes your decisions. Agentic AI is your hands and limbs. It's doing certain things for you. It's executing things for you. And IP, intelligent process automation, is putting the guardrails in place. Your mind controlling things.
Good analogy. So there we go. We've talked about mini-lateralism, new types of partnerships. We've talked about data silos and trade silos, but we've also talked about opportunities through agentic artificial intelligence and intelligent processing automation.
Yes.
That was Mariya George, CEO at Cleareye here in Jersey City.